Good morning. This is Larry McMillan with a market update on Monday, July 27th, before the market opens. So the S&P has struggled a bit recently, keeps running into these resistance areas. However, the bears aren't making any progress either. If we recount sort of what's happened over the last month, S&P had that island reversal, then it's tried to recover since then. It had a bumping around in about the 31.55 area, then 31.85, then 32.35, and then last week 32.80. So these are all fairly close together, but each one is a bit of a support level now that it's been exceeded. On Friday, things deteriorated a bit, but unless we fall back through all those support levels, I still think the bulls are in charge. So let's just round it off and say any close below 3,100 would definitely be bearish. But until then, the S&P chart still has a bullish slant, and the bulls can just count anything else as a reloading of the machine on the way back up again. Put call ratios are still extremely overbought, trading at multi-year lows, but they haven't started to curl upwards yet. I did take a look at the data, and since these are 21-day moving averages that we use, it turns out that in about 2 or 3 days, we're going to start to see some really low numbers coming off the moving average. So if we were to get some fairly high ones coming on, let's say some bearish action in the middle to late part of this coming week, that will probably turn the put-call ratios decidedly negative. But for right now, they're just overbought. They are not on sell signals yet. Breadth has been, weak as always. It just can't seem to get anything really going. And so our stocks only breadth oscillator has already fallen back to a sell signal as of Friday's relatively poor breadth day. The New York Stock Exchange breadth oscillator is just clinging to a buy signal, but any negative breadth today probably, if it closes with negative breadth today, would definitely put that one on a sell signal as well. Volatility, on the other hand, though, is still hanging in there. The VIX itself crossed below its 200-day moving average, which is positive, but it's not the complete buy signal we're looking for. That would entail the 20-day moving average of VIX also closing below the 200-day. Right now, they're about 1 point apart. The 20-day moving average is just above 28, and the 200-day moving average is just below 27. So if the 20-day crosses below the 200-day, that will complete an intermediate term buy signal. Those have generally been pretty good, really going all the way back to the sort of famous one in March of 2009. So the short term at VIX is we're still operating on that VIX spike peak buy signal that occurred a couple of weeks ago, but any significant short term rise in VIX would stop that out. So overall, things are deteriorating a bit. I mean, we are seeing weakness in breadth. Put-call ratios probably could roll over to sell signals fairly easily, but it's the S&P chart that's really still the master indicator, and that is still positive as long as S&P continues to close above 3,100. So enjoy the week and good luck trading.